Welcome to our deep dive. We're cracking open Morgan Housel's The Psychology of Money. And let me tell you, it's not your typical finance book.
No, not at all. It's not about, picking stocks or becoming some kind of Wall Street wizard.
Right. This book is about the stories. The stories we all tell ourselves about money.
Yeah, those stories we carry around, often based on our own experiences. And they can really, either set us up for success or kind of hold us back.
So true. And Housel kicks things off by pointing out that, honestly, when it comes to money, we're all a bit crazy.
Yeah. But the thing is, everyone's crazy is different.
Right.
Shaped by their own background.
Totally. Your family, how you grew up, even what was going on in the world when you were a kid.
All of it. Housel contrasts these two really interesting stories. Ronald Reed, a janitor. This guy quietly built an $8 million fortune.
Wow.
And then Richard Fiscone, Harvard MBA, ended up filing for bankruptcy.
Let's talk about two different paths. But it really shows you, right, our experiences, they shape our whole view of money. Like with Ronald Reed, I was blown away reading that story. Just goes to show long-term thinking and good habits, they pay off.
For sure. And Housel uses these stories to challenge our assumptions, who's good with money, who isn't. He even talks about, lottery tickets and why people with lower incomes might play them more often.
Oh, that's interesting.
It's not just about, a lack of financial education, right?
Really?
It's this deep desire for a dream, a chance to, break free.
Yeah, like a tangible hope you can hold on to.
Yeah.
So instead of judging, we can try to understand their motivations. What stories are they telling themselves? How's that affecting their choices?
Exactly. And that brings us to this whole idea of luck versus skill.
Ooh, big topic.
Huge. Housel says financial success, it's not always a pure meritocracy. The smartest and the hardest workers, they don't always end up on top. He uses the example of Bill Gates, obviously incredibly successful, but then he contrasts Gates with his friend, Tent Evans. Equally brilliant, but tragically died young.
Wow, yeah. Sometimes it really is better to be lucky than good. Of course, it's best to be both, but life throws those curveballs.
Right. You just never know. And Housel even talks about cases like Rajat Gupta, the McKinsey CEO, went to prison for insider trading.
Well, yeah.
And then Bernie Madoff orchestrated a massive Ponzi scheme. These were incredibly successful people who, they made some terrible choices.
Driven by that desire for more.
It's a cautionary tale, right? The danger of greed and figuring out what does enough even mean for you.
Absolutely. Okay, so let's shift gears a bit. Talk about compounding.
Yes, the eighth wonder of the world.
Right. But honestly, sometimes I struggle with grasping just how powerful compounding can be.
So Housel has this great analogy, compares compounding to, believe it or not, an ice age.
An ice age?
Yeah. Think about it. Small changes over long periods, they lead to massive results. Just like a little leftover snow each year, eventually you get a giant glacier.
Okay, I can picture that.
Right. Same thing with investing. Housel points out Warren Buffett built most of his wealth after turning 50.
Wow, it's wild how much our brains just don't get exponential growth.
We're wired for linear thinking.
It's like those old photos of computers, right?
Yeah.
Taking up a whole room. We've come a long way. But our investments can do the same thing with enough time.
Absolutely. Okay, now switching gears again. Getting rich is one thing, but staying rich, that seems like a whole other challenge.
For sure. So what does Housel say about that?
Well, he says staying rich requires a totally different mindset. It's about frugality, a bit of paranoia, being prepared for things to go wrong.
Like always expecting a storm.
Kind of. He contrasts Jesse Livermore, this legendary trader, made and lost fortunes multiple times, and then Abraham Germansky lost everything in the '29 crash.
It's about riding those waves, but not getting wiped out when the tide turns. Like those surfers who handle the biggest waves, right? Years of practice.
Perfect analogy. And that leads to this crucial idea. Margin of safety. Housel compares it to, get this, blackjack card counting.
Okay.
Even with a good strategy, you need enough capital to handle those losing streaks.
So you need that buffer, that cushion. It's like an emergency fund, right? Or padding your schedule so you're not constantly stressed.
Exactly. Margin of safety, it's crucial for everything. Budgeting, investing, even career choices. You got to acknowledge life's unpredictable.
Okay, let's talk about something both exciting and kind of scary. Those investment returns.
Yes, we all want them.
But Housel reminds us, those returns, they come with a price.
Like buying a fancy car, right?
Ooh, I like that analogy.
High price tag for all the bells and whistles. Same with investments. High returns, you got to accept some volatility.
Can't drive a Ferrari and expect perfectly smooth roads.
Right. Housel uses the S&P 500 chart. Even in periods of growth, the market spends a lot of time below its previous highs.
Trying to avoid those dips. It's like trying to time the market.
Exactly. Might get lucky sometimes, but it's a risky game.
Okay, now let's dive into something I find really fascinating. The power of stories. How they shape our money choices.
Ah, yes. Stories, they're powerful. They give us a way to make sense of the world, you know?
Like connect the dots puzzles.
Yeah.
We take all these random bits of info, our brains make a picture that seems to make sense.
Exactly. But sometimes those narratives, they're not accurate or objective.
We get biased by our fears and hopes.
For sure. And especially in finance, certain stories dominate. Like, think about the media, always hungry for that drama.
Market crash. Run for your lives. Ha ha.
Right. We get bombarded with negativity, and it really warps how we see risk and opportunity.
We become more scared, more cautious, maybe miss out on chances to grow.
It's like we're so busy worrying about the monsters under the bed, we forget to look at the beautiful view outside the window.
And speaking of negativity, why does pessimism seem so much more believable than optimism? Especially with money.
Well, bad news grabs attention, right? It's more exciting. Company goes bankrupt, that's a headline. Company quietly growing for years, no one cares.
Makes sense. It's like disaster movies always being bigger hits than heartwarming stories.
Exactly. And with money, it's even trickier. Even if we don't own stocks, the stock market feels connected to how well we're doing in life.
It's like a reflection on us personally, even if it shouldn't be.
House says this focus on the negative, it gives us a warped view. We underestimate how resilient and innovative humans can be.
Like we forget we're pretty good at solving problems.
Right. Take the oil crisis in the early 2000s. Experts predicted peak oil, prices going through the roof.
Yeah, I remember that. Scary stuff.
But what happened?
Well, we figured things out, right?
We did. Fracking technology came along, boom, more oil production than anyone expected.
Pessimism always forgets we're pretty good at adapting. Okay, so last thing for this part. You mentioned understanding what game you're playing.
Oh, yes. It's crucial. We tend to lump everyone who invests into one big category.
Investor.
Yeah,
But everyone has different goals.
totally. It's like you wouldn't just say, I want to be an athlete. You'd say, I want to be a marathon runner or a power lifter, right?
Makes sense. Different goals, different training.
Same with investing. Short-term traders are different from long-term investors. Someone who wants to build a comfy lifestyle is different from someone who wants to build a massive fortune.
It's about defining your game, then picking the right strategies.
Exactly. Housel actually encourages everyone to write a personal investment mission statement.
Never thought about that.
What are your core beliefs about the world? Your goals? What's your time frame?
So you can stop comparing yourself to others and make choices that actually fit your life.
Precisely. It's so easy to get swept up in what other people are doing, but it's your game that matters. It's so true. All right, well, that's a great place to pause. We'll pick back up in part 2 with even more from the psychology of money. Stay tuned. Welcome back. We're diving deeper into the psychology of money. And this time, we're getting into some really counterintuitive ideas, stuff that might change how you think about wealth and success.
Yeah, Housel really challenges us to think differently about what wealth actually means. He says it's not about what you see, like the fancy stuff, cars, houses.
Right.
It's about what you don't see.
Okay, now that's interesting. How can wealth be about what you don't see?
Well, he talks about his time working as a valet in L.A. Saw tons of people driving expensive cars. But they weren't necessarily wealthy, Often they were sacrificing financial stability just to live successful.
It's like, don't judge a book by its cover. Someone might look rich, but be drowning in debt just to keep up appearances.
Exactly. Housel makes this key distinction. Being rich is about your income, what you can buy right now. Being wealthy, that's about what you don't spend. It's about having that cushion, that freedom. So it's like true wealth is about building this invaluable fortress, knowing you're prepared for whatever life throws at you.
Yeah, like that classic story, right? The farmer who saves diligently versus the banker who spends lavishly. The farmer is the one who's truly secure.
I love that story.
Yeah.
Simple, but powerful.
And it highlights this point Housel keeps making. Building wealth, it's not just about earning a lot.
So it's not about your income.
It's about your savings rate, how much you keep, not just how much you make.
Makes sense.
And he uses this analogy, might surprise you. He talks about the oil crisis in the 70s.
Oh, yeah, peak oil, right. Everyone thought the world was running out.
It was a big concern. But what actually saved us wasn't just finding more oil.
What was it then?
It was becoming more efficient with the oil we already had.
So kind of like reducing our energy consumption, more
Yeah.
fuel-efficient cars, that kind of thing.
Exactly. And Housel says the same idea applies to building wealth. It's not always about earning more.
It's about using what we have better. Like, instead of always wanting a bigger paycheck, maybe we can focus on spending less, being less wasteful.
Precisely. And this ties into another crucial thing, flexibility.
Flexibility. Ooh, yeah, in today's world, that's huge. Jobs change so fast, industries get disrupted, you got to be able to adapt.
Exactly. And financial security, having savings, that gives you the flexibility to make different choices. Take a lower paying job you actually love, maybe.
Right, you're not trapped. Or if you face unemployment, you've got that buffer.
It's not just about accumulating wealth for the future. It's about having choices in the present. Okay, ready for a curveball.
Hit me with it.
Let's talk about Las Vegas casinos.
Wait, casinos.
Yeah. Now, most people go there to gamble, obviously, but Housel focuses on a specific type of player, the card counters.
The ones who try to beat the house by keeping track of the cards. Always wanted to learn how to do that.
It's complex, but there's a key lesson they understand: the importance of room for error.
So even with a good strategy, they know they can still lose.
Of course. Luck is always a factor. So they make sure they have enough money to handle those losing streaks. They're in it for the long game.
Makes sense. It's not about winning every hand, it's about surviving the downswings.
And Housel says this room for error idea, it's crucial for everything in finance: investing, budgeting, even your career choices.
Can you give an example, like with retirement planning?
Sure. Let's say you're looking at historical stock market returns to figure out how much you need to save.
Right, those charts that show how the market's done over time.
Those can be helpful, but the future is uncertain. What worked in the past might not work the same way going forward.
You can't just assume things will keep going up, up, up.
Exactly. That's where room for error comes in. You assume lower returns, you save more than you think you need, you give yourself a buffer.
So even if things don't go as planned, you're okay, like having that safety net.
Exactly. All right, another thought-provoking idea from Housel: the difference between being rational and being reasonable with your money.
Okay, I'm listening. What's the difference?
Rationality is all about logic, data, probabilities, like optimizing for the highest return no matter what.
Like a robot making decisions.
Haha, kind of. But reasonableness, it takes into account human behavior, our emotions, our circumstances.
It's more holistic, right? Like sometimes it makes sense to do something even if the numbers aren't perfect.
Exactly. Housel says sometimes it's totally reasonable to deviate from pure logic. Like, think about home bias. Investors tend to favor companies from their own country.
Yeah, even if it's not the most rational way to diversify.
Right. But there's a reason for it. Investing involves trusting people with your money. Feeling familiar with those people, even if it's just because they're from the same place, it can make a difference.
Makes sense. We're not always driven by pure logic. Like, we know a salad is healthier, but sometimes you just got to have that burger.
Haha, exactly. Emotions matter. Okay, last thing I want to touch on. This temptation we all face. The allure of getting something for nothing.
Oh, yeah. That's a big one. Shortcuts, easy money, we all want it, even if we know it's too good to be true.
It's human nature, and the financial world is full of traps that exploit that desire.
For sure.
Housel uses this great example. Jack Welch, the CEO of General Electric. He was considered like a management rock star. Always beat earnings estimates.
He was super famous, right?
He was. But, it turns out, he was manipulating the numbers, creating this illusion of perfect growth.
So instead of accepting volatility, he was just hiding it.
Yeah.
Kicking the can down the road.
Exactly. And that's the danger of trying to outsmart the market, always looking for that easy win. The price of success, whether it's volatility or plain hard work, it always comes due. There's no escaping that.
It's like trying to cheat at a game. Might work for a bit, but eventually you get caught. Okay, so we talked before about the power of narratives. But I want to dig a little deeper. How these stories we tell ourselves, how they really impact our money choices.
Yeah, it's a key part of this whole psychology of money thing. Our brains, they're bombarded with information constantly, right? And we try to make sense of it all by creating stories.
Like, our brains are always writing a novel.
Exactly. The problem is, these stories, they're not always true or even objective. We bring our biases, our fears, our hopes into it.
We choose what information we pay attention to, right? Like confirmation bias. We focus on stuff that supports our existing beliefs.
Exactly. And in the financial world, certain stories just dominate, especially in the media. Bad news is more exciting.
Oh, for sure. Markets crashing. Sell everything. That gets clicks.
Right. And all this negativity, it warps our perspective. We see the world as more dangerous than it really is.
We become more cautious, maybe miss out on opportunities because we're too scared.
It's like we're so busy looking out for that boogeyman, we forget to enjoy the sunshine, you know?
I get it. And speaking of negativity, why is pessimism just so much more convincing than optimism when it comes to money, especially?
Well, part of it is just how our brains work. Bad news grabs our attention more. It's like a plane crash is news, but a plane landing safely, that's not.
Yeah, that's just expected.
And with money, it gets even more complicated. Even if you don't invest in stocks, the stock market feels like this indicator of how well we're doing personally.
So even small dips, they feel like a personal failure, even though they're not.
Exactly. Housel argues this focus on the negative, it makes us miss the bigger picture. Like, we underestimate how good humans are at solving problems.
Right, we're pretty resilient.
We are. Remember that oil crisis we talked about?
Yeah.
Experts predicted peak oil prices skyrocketing. What happened?
We found new ways to get oil, right? Fracking took off.
Exactly. Pessimism often forgets to account for human ingenuity. We find solutions.
We adapt.
We do, and sometimes we just need to remind ourselves of that.
Welcome back for the final part of our deep dive into the psychology of money. We've covered a lot, from those kind of crazy money habits we all have to how powerful stories can be. What's really stuck with you so far?
It's hard to pick just one thing, but this idea of humility, it keeps coming up, you know? Housel really emphasizes that.
Yeah. It's like we think we can predict and control everything, especially with money.
Right. And as we've been talking about, the future rarely goes according to plan.
Nope, it sure doesn't.
Housel reminds us we're dealing with human behavior here. And that's messy and unpredictable, not always logical.
So how do we embrace that humility? Like, how do we acknowledge those limits without getting stuck?
Well, Housel uses this amazing example. NASA's New Horizons mission.
Oh yeah, the spacecraft that went to Pluto.
That one. 9-year journey, traveled billions of miles, pinpoint accuracy, amazing feat of engineering. Right.
It's mind-blowing. Talk about setting a goal and actually achieving it.
It is. But here's the thing. Astrophysics, it's precise. Laws of physics, they're constant. We can predict a spacecraft's path really well.
But finance, it's different, right?
Totally different. Finance is about human behavior, emotions, decisions, all that messy stuff.
It's more like trying to predict the weather, I guess.
Exactly. You can have all the data in the world, but there's always that element of you just don't know.
So that's where humility comes in.
It's crucial, acknowledging we don't know everything. We can't control every outcome, especially when other people are involved.
So it's about having a plan, but being flexible, rolling with the punches.
Exactly. Accepting the uncertainty instead of fighting it. Okay, ready for another brain twister?
Hit me.
It's something Housel calls the end of history illusion.
End of history illusion.
Yeah, it's this idea that we think our values, our goals, they'll stay the same forever.
Like we picture our future selves as just older versions of who we are now.
Exactly. Same priorities, same dreams. But as Housel points out, we're always changing, right?
Oh, absolutely. The things I cared about in my 20s, totally different now. My idea of success has changed completely.
And that's the thing. This illusion of a static self, it can lead to bad choices. We make decisions based on who we are now, and then later, our priorities shift.
It's like delaying gratification forever. You sacrifice now for a future that might not even be what you want anymore.
Right. So Housel gives some advice. First, avoid those extreme choices. Find a balance between enjoying today and planning for tomorrow.
Don't put all your eggs in one basket kind of thing.
Exactly. Second, be willing to abandon old goals. If something made sense back then but not anymore, it's okay to let it go.
Give yourself permission to change, to adapt.
Exactly. Your financial plans, they should evolve with you. Now, this next one, I think we've all struggled with this. Sunk costs.
Ugh, sunk costs. I hate those.
We all do, but they can be so hard to let go of.
It's like, I've invested so much already, I got to keep going, even when it's clearly a bad idea.
Housel tells this great story. Jason Zweig, financial journalist, writing a book with a psychologist. Several drafts in, the psychologist says, nope, we got to start over.
Wow, really? That takes guts.
Right. But when Zweig asked how he could just abandon all that work, the psychologist said, I have no sunk costs.
Powerful way to look at it.
It's a reminder to focus on what's best for the future, not get hung up on past effort. Okay, so wrapping up our deep dive into the psychology of money, some key takeaways.
First, this is a big one. Understanding the psychology of money is just as important as understanding the financial stuff itself.
Totally. Our emotions, our biases, they drive so many of our money choices.
Second, remember the role of luck and risk. We often think we're in control, but sometimes it's just being in the right or wrong place at the right time.
You can be skilled and hardworking, but still get hit by something unexpected.
Third, balance that rationality with reasonableness. Logic is important, but don't forget about your emotions, your personal circumstances.
I gotta feel right, not just look good on a spreadsheet.
Fourth, let's not forget the power of compounding. Save consistently, give those investments time to grow. Small actions now can have huge results down the road.
It's a marathon, not a sprint. Patience, patience, patience.
And finally, be humble, be adaptable, be willing to learn and change. The world of money is always evolving, so we have to evolve with it.
Couldn't have said it better myself. So as we wrap up, I want to leave everyone with this question. Knowing what you now know, how might you approach your own money decisions differently? What stories are you telling yourself about money? And are those stories helping you or holding you back? That's something to really think about.
Great question to ponder. And that's it for our deep dive into the psychology of money. We hope you enjoyed it. Keep learning, keep exploring, and keep questioning those money stories.